the biggest issues that I have about funds are costs and returns. And this is a central point about investing. Are you spending too much money to maintain that flat of yours so that your returns go down? Are you going to get enough of returns from that flat to justify spending that money? That's on real estate. Same thing about stocks. Mutual funds charge you 1.9, 2.3, 2.7, 2.8. It varies every year, whether you make money or not. So if you put them on, give them a lakh of rupees, you're going to be charged 2.8% of that every year, or 2.3% of that every year. The fund is very large, the charges are a little less, whether you make money or not. This cost drags down the returns. Let me explain how it works. Now, this is the growth of a 10 lakh portfolio over 5 years post cost. Okay. Between a stock portfolio and a mutual fund portfolio, I have assumed returns which are identical. And yet, if you notice, the stock portfolio has hugely outperformed the mutual fund portfolio or the same rate of return. Doesn't matter what the rate of return is. Maybe it is 15% or so. You would notice something quite interesting. There are 4 legends there. Stock portfolio, how much is the value? Mutual fund portfolio, how much is the value? Trading and demand charges, mutual fund expenses. I have only 3 on the chart. Where is the 4th one? So the 2 portfolio values are there, mutual fund expenses are there, but the 4th one, which is trading and demand charges, just doesn't register in the chart. It is so little. 2.3% impact can be gauged not only with the bar chart, but with an alternative, with the option of buying stocks and noticing that it doesn't pinch you anywhere. I can't even register it in the chart. It's so little, roughly 2,000 rupees per annum. Now, where is the funds? Where do the funds become expensive? Gross return is about 17%. Let's say fees are about 3% or so, and net return is about 14%. Now, this is a yearly cost of a 10 lakh portfolio: 23,000 and 2,000. All right. If you take this same story over a 25-year period, 31 lakhs goes in mutual funds and only 52,000 in stocks. Impact of cost. If you put these costs in the fund, what happens? We try to correlate returns and costs. Do funds which charge you higher costs, do the returns go down or not? That would be a very nice example, very nice way of correlating. And this is exactly what has happened. If you see this is how the costs go up, and if you see how the returns go down. Just check. I'd mentioned that I'm going to come back to the issue of professional management, which I said is not such a strong reason by itself to buy funds. This is a 5-year return of 168 schemes which were there 5 years ago, as on 30th April 2015. This is a real life story of what actually can happen. Not this fund or that fund, but across the board what could happen to funds. Top 15 schemes gave you a return of 21%. All the schemes on an average, immediately the return drops to only 13%, the average of all the schemes. Bottom 15 schemes minus 5%. Same period. 5 years, 168 schemes. 168 schemes have 168 fund managers. And all of them are IITIM and all of that, from top MP, 168 jobs only. Okay, there are fund managers. Everybody wants to be a fund manager. All financial analysts want to manage money. That's the dream. And only 168 jobs in a nation of 1.25 billion people. And see the variation between them. All of them are owned by top quality companies, quality owners. It could be foreign, Indian, doesn't matter. It could be JP Morgan, could be LIC Nomura. Nomura is a giant. One of those will be probably Nomura. Now, They're all the same, and you meet them, they're all very smart people. They know exactly what to do. They're fantastic with spreadsheets. Excel is like so easy for them. And yet, this every time when I look at this variation, I ask myself, how is an average person going to believe if he has bought some of those by listening to X or Y? Because there are multiple ways one can get advice. You can get advice by somebody on TV, by reading, a friend, anything else other than your own hard work, right? So if somebody had bought any of those funds in this area, he'd never buy stocks in his life. So professional management is not something that I would pay too much of a premium on. Yes, I would pay premium for performance, which, as I said, go over 10 years or 7 years or so. Now, to take forward the way I've said choose your funds, 5 years ago, let's replay what we could have done. 5 years ago, we have looked at these 5 stocks, and once through this choice, I'm going to move from funds to stocks. 5 years ago, these were the top 5 funds. Okay, HDFC top 200. 30%, 30% again, 29.98, and Birla Sunlife Frontline 28. Hardly much to choose from. They're all neck and neck. They're all fantastic companies, great. What do? We choose from this. Okay. But the problem is, you choose from this, you get the good and the bad as well. These funds over the next 5 years obviously won't do as well over every 5-year period. And they give you a return, not bad still, but 12%, 13%, and so on and so forth. So your choice was more or less not bad. It's not minus 5% category and so on. You got a fairly good return in a period which was, the market wasn't doing too well. Now, the problem is that these funds had all kinds of stocks. There were stocks in cyclical business. There was Reliance Industries in it. There was Jindal Steel and Power. All kinds of stocks were there in their portfolio. Let's look at what were these stocks. The top 5 funds. Look at the top stocks in these top 5 funds. These were the stocks. I have marked some of them in pink for a reason. 5 years ago, if somebody had asked me to choose from these are the ones that I would not choose. At any time, if you wake me up in the middle of the night and if you say Reliance Industries or State Bank, I would say no. No matter what my mental state is. Okay? These were the stocks in the portfolio 5 years ago. Now, let's look at the returns of all these stocks. I have 2 parameters over here. One is return on net worth, and that will give you an idea of why I would not choose these stocks. That is, how much return the company is making on our money which is invested with the companies. The second return is actually the market return, where the stocks were at that time, and 5 years where the stocks went. SBI gave a return of 3%. Reliance is actually down. Okay? And of course there is Jindal Steel and Jindal Stainless and BHEL and all of that. Clearly, all kinds of stocks were there in this portfolio, not just high quality stocks.
This return is for which 5-year period? This is for the
Same.
Up to 2010.
Yeah.
5 to.
Yeah. Now, no. Those 30% return was from 2005 2010. When we were in 2010, we chose those 5 mutual funds. Those mutual funds had these stocks in 2005, and this is a return over that period. Mutual fund returns are 12%, 11%, and so on. These are the returns of the stocks in those funds. These are top stocks, almost covering 75%. So I took 75% by weight, by value for all of these funds, put them together. This is eliminated the common ones. This is what I got. Now, my question is, can we do better than this? And I'll give you a theoretical answer and a practical answer to this. Let's look at the top stocks once again. These are the ones which are there in the portfolio. Okay. And I picked the ones which I would like. And what would happen to my portfolio? This is quite dramatic. Average of top stocks in top funds. I don't know if you noticed this. Notice the average figures below. In this entire period, Nifty itself has gone up 9.16%. And the average performance of this entire stock in the portfolio is 9%. These are the top stocks chosen by mutual funds, for which they're charging you 2% plus. So if you had bought Nifty, a beginner would have bought Nifty. He would not have to bother about choosing funds. He would not have to bother about choosing stocks. He would do as well as the average of this. Of course, the fund manager is a little more smarter, so that's why he got you 12% and 11% return more than the Nifty in two ways. Maybe he invested a little more on the better performing stocks. It's a weightage that they give. This is equal weight. If you put same amount of money in all of this is the return what it would be. But net in 5 years, the top stocks in the best performing funds, 9.16%, 9% return. Nifty is 9% return. Now, I was saying that I would not have chosen these, the pink ones, and the rest I would choose. Their choice, okay? I'm not even saying I will choose some other stocks. My universe, my sample is only their choice. I'm just eliminating ones that I don't like from their choice. That's all I've done. What would be the performance? It's quite dramatic. As I said, I repeat, average was 9%, Nifty was 9.6%, average of the top 5 funds was 13%, and our portfolio, minus those pink ones which I don't want to choose only, is 17.74%. Significantly higher, 5 percentage points higher than somebody who's being paid crores of rupees to manage your money. Not bad. Now, you can always turn around and say, this is all hindsight. You know what performed, didn't perform, and you eliminated based on what you know. You didn't apply any method or anything, and you know Reliance has not performed. I don't trust you. Fine, don't trust me. This is what you have actually done. This is a cover story based on the same principle. Live example, not hindsight. Look at this. This is the formula applied in this cover story. The story came out in December 2013. Same process. Best stocks from best equity funds. You can go and pay 99 rupees only and read it on the website if you're not a subscriber. How have we done? This is a portfolio. It has done 39.5%. Everybody also has done fairly well in the last 1.5 years. So, top 35 schemes. But this method has beaten 92 of the 97 schemes which we had picked up. So it's possible. How is it possible? I'll show you. Funds charge us 2%, 2.5% and so on. According to me, they should do much better. If HDFC mutual fund is given 21% compounded annual return, they should have given 27% in my view. If they have done 12% in last 5 years, they should have done 17%, 18% in my view. At least 3 to 4 percentage points higher they should be giving, because they're charging me that money. Okay. Now, just go back to all that I'm saying. If you were just bought only the stocks that HDFC mutual fund has bought, same stocks, it's published every month, you can save that 2.3%. Straight away you can add that back to your portfolio, right? Because charges of demat is nothing. And today you can buy stocks for 20 rupees at Zerodha. So it's a negligible cost for somebody who is having 1 lakh portfolio also. 20 rupees is what? Vada pav. Okay? So you save that 2.3% straight away. So I'll pay you 2.3% for what? For 3 things. 1, for stock selection. Not for selecting Reliance, not for selecting BHEL, not for selecting State Bank of India of the world. For selecting a Lupin and a Dr. Reddy, well known, but you should know that these are expensive stocks, but they will go even higher. That is something that you should have known, right? 1. 2, if at all, for the crores of rupees that they are charging us every year, and the amount of money they are making on their own invested capital, it's 200-300% by the way for some of these funds, because to run a fund, it doesn't need that much of capital. And once the fund goes to a certain size, the incremental cost is nothing, and every month all this 2.2% business is coming in every month, irrespective of the performance. So I would expect them to get out of the market when it's expensive, get back in to the market when it's cheaper, or even within stocks, get out of certain stocks when they become expensive, like Symphony. I'm just giving an example. It just shot up, became 2,600. Now it's back 2,600, now back to 2,000 or so. I would expect them to get out of these stocks and get back in. So smart buying and selling is what I would pay for, most certainly. And that will add another 4-5 percentage points. If they tell you, we are not into buying and selling, there are 2 issues to it. A, they are lying, because funds keep churning the portfolio. There are some funds which is with an 88% churn in the portfolio. 88% of the stocks are new or fully changed within 1 year, whereas you are supposed to hold for the long term in their funds. And third thing, exposure weights. You should know, for instance, and that's why I'm paying you more money, that X stock will do better than Y. So you will buy more of X and less of Y. This is called weights. If you can't run an equal weighted portfolio, if you were to run an equal weighted portfolio, you will have 30 stocks, 3.33% each. Only 50 stocks, 2% each. All right, but you have chosen to put 7.5% in something and 3.98% in something else. Yes.
Individual investor, I don't have the advantage of taxation which the mutual fund has.
Why?
No, because they can buy and sell and they don't get taxed.
I'm not asking you to buy and sell. I'm saying my paying money, a higher charge to them for an investor who's serious, who's interested in managing his own money carefully and smartly, for them to pay 2.3% to a fund manager, this would be the expectation. Let's see what they do on this score. Stock selection. Most funds have the same similar kind of stocks in the portfolio. Why? Because they want to outperform the benchmark. What is the benchmark? According to SEBI, when you launch a new fund, you have to say what is your benchmark for the fund. You have to choose a publicly available index. Sometimes it's private index also, calculated. Like Reliance Entertainment Fund is benchmarked to an index which they've created. So you have to say, I want to be compared to Nifty, or I want to be compared to BSE 200 or whatever. So that is your benchmark. Once you do that, then the funds would go and buy most of the stocks in the benchmark, so as not to move too much away from the performance of the benchmark. If you move too far away, the salespeople will come and tell them, people are asking, how is it that Sensex has gone up 5% and you are down 2%? They don't want to take the chance even for a short period. Now, as many as 86 of the 200 actively managed diversified mutual funds have Reliance in the portfolio. One of the worst performing large cap stocks of the last 5 years. I would not buy this stock in any case. Forget about 5 years, 2 years, 10 years. Why do funds buy Reliance? Because Reliance is there in all benchmarks. So whether it's to 1% or 5% or 3%, they have to put the money in Reliance. It's like a compulsion. This is not stock selection. This is not finding out a great company that is going to grow over a period of time and give you great returns. This is playing safe with your money. And Reliance is down 21% in 6 years from May 2009. These two funds give you a great insight into how funds actually buy their stocks. HDFC equity, HDFC top 200. See the stocks in the two portfolios. It's the same. Identical stocks, the weights are only little different. 37 stocks are common. 85% of the portfolio is common. 85%. Two different schemes. This is not stock selection. The fund manager of one and the fund manager of other are just thinking alike, identically. And thinking in terms of all index stocks. Thinking in terms of State Bank, ICICI, Larsen Toubro, Infosys, Maruti, BPCL, Bharti, Tata Motors. All index stocks. You might as well buy Nifty and save that 2.3%. Evidence number 2. The performance of these two funds vis-a-vis BSE 200. This is called indexing, closet indexing, the disguised indexing. You are buying an index, but you are pretending that you are actively managing, and please pay me 2.3% and so on. So I proved my first point, that they cannot be demanding 2.3%, 2% from me for stock selection. The stock selection is nothing great to write about. I've already explained what I would have done, and I've proven it in a publicly available article, and now I've proven in the portfolio of HDFC just as an illustration. Point number 2, buying and selling. To create more long-term wealth, frequent buying and selling is not needed. There's no doubt about it. But what is definitely needed is to reduce your exposure to stocks once in whenever, 5 years, 10 years, when the market becomes very, very expensive. Market became expensive in December 2010. Market became expensive in January 2015. Market became expensive in January 2008. These are not with the benefit of hindsight. These, I can tell you exactly next when the market becomes expensive. It's still expensive now, according to me. This is the time, based on your research, you should be reducing your exposure to stocks, if you have not already reduced. But funds don't do that. Most of the funds are now 90% invested. For the last 5 months, market has been expensive. There's only one fund which has taken the trouble to trim its exposure. 2. One significantly, which is Quantum, and one ICICI fund, which is second. Funds don't do it. They don't even try to time. And by timing, I don't mean day trading. I don't mean trading over the week, month, or whatever. I mean occasional trimming of portfolio when you are very clear either the stock is outperformed or the market is overvalued. They don't even try to do any of this. Third, look at these two examples. I ask a question, I get very interesting answer. I asked Jason, do a comparison between State Bank of India and State Bank of India blue chip equity. And let's see what they did. I mean, nobody has to do anything to State Bank of India. It's a market-based thing. It's a stock. It fell. State Bank of India blue chip fund managers could have sidestepped this. We could have had a situation where it both falls, but it falls a little less or substantially less. It goes sideways somewhere. You move out of stocks. They are not able to do this. What more evidence do you need that even at a time in January 2008 when the market has become horribly undervalued, over the course of the next 3 months, the US economy, US financial markets were collapsing. Oil prices started falling in after July. At no stage has the SBI blue chip equity fund manager been able to do significantly better than SBI, the stock itself, which went down sharply with the market, and so did the blue chip equity fund. Third, which is weights. So my first point was stock selection, second point was timing, occasional timing, third point is weights. There is absolutely no scientific basis for this kind of a look that you see in a portfolio. You go to value research, you will, any portfolio, anywhere you will see these weights, meaning these are the exposure. So 7.6% of the portfolio is exposed to State Bank of India equity. Why 7.6? Why not 5? Why not 3? Why not equal? Why not say, I don't know how the stocks are going to perform in future? Nobody really knows. You can have a little more conviction about one stock or the other, but having picked a stock, how is it that you're sure that SBI it deserves a far greater exposure than, let's say, ITC or HDFC Bank? So I'm concluding point of my presentation, and after this I'll take questions. Buy stocks of high quality. It's as simple as that. You can pick them from the mutual funds portfolio itself. You can ask me how to pick stocks, and there are 6,000 companies and there are 300 companies. Share your database with me. Not all that is not needed. Take top 5 or 6 of these funds. UTI is a very good fund, UTI equity fund. Anything that Anup Bhaskar handles, good. Anything that Prashant Jain handles, good. Anything, some of the Reliance funds are good. ICICI funds are good. Take all of them, all the stocks in one place, in one Excel sheet. Find out against them what is the return on capital employed. Choose the top 20. You're not going to go wrong. You're going to beat the fund managers. I'm quite certain about it. I have done it. You can do it too. There's no doubt about that. And the cost is nothing, which is your demat charges and buying one time. All right. As for selling, the National Stock Exchange publishes a PE of the whole market, price to earnings ratio. It's based on last 4 quarters of profits. If the PE is above 23, 24, the market is expensive. If the market is expensive, think of bringing down stocks that have gone up a bit. Okay. Remember, it's all a game of probability and approximation. Our whole approach should not be to maximize. Our whole approach should be to be satisfied that A, we have got tax-free gains, which is far higher than bank interest. B, we would have beaten 60 to 70% of the fund managers in any case. So last extra bit of money you haven't got, you sold early, the stock has gone up, train your mind to be happy. In any case, that is, you know that it's all about probability and approximation, as I mentioned, and nothing more is needed.